Hi everybody, welcome to Module 1. The focus of this lecture is our financial foundations. And we're going to be discussing the following items. We'll begin with just a recap of the road to value creation, which we saw in the first lecture. And then really we'll focus the rest of this lecture on the tools that help us to get there. Specifically, we're going to do a quick review of the financial statements, and we'll link that to something called the free cash flows, which is used throughout our field of corporate finance. And then we'll talk a little bit about ratio analyses and how those are used. And finally, I want to provide a visual wrap-up of where this lecture resides within the entire course. So the place to begin is the road to value creation. We saw from our opening lecture, from the course overview lecture, that the goal of financial managers is to focus on creating shareholder value. They're trying to maximize shareholder value. Or more generally, they're trying to just create firm level value. So all their decisions should be with an eye towards whether or not the decision will enhance value. In order to make such decisions, they really need some diagnostic tools. And the most important diagnostic tools are some of the ones that we're going to be discussing over the next several minutes. Now, the first place to stop for a financial manager trying to create value really is the financial statements. The financial statements, these are our accounting statements, and these are snapshots that help us understand really what's going on in the company. So the most important one is, well, there's a few, and the balance sheet, the income statement, and the statement of cash flows are typically the three most important ones. We'll just start briefly with the balance sheet. So the balance sheet provides a snapshot of the company's assets, what the company owns, and its liabilities, or who owns what of the company. And both the assets and the liabilities are grouped into short and long-term horizons. I'll show this on a subsequent slide in a little bit more detail. The income statement is probably our next most important financial statement. And this shows the net profits over a given period of time. So typically this is done on a quarterly or yearly basis. And it broadly categorizes items into their revenues, operating expenses, other expenses. And it's just trying to answer the question, what were the costs of the sale? What were the costs relative to the sales we made this period? Finally, companies really want to understand their cash positions and cash usage. So the statement of cash flows provides that level of detail, and it's a breakdown of all the cash activity categorized into three buckets: operating, investment, and financing for a given period. So I'm going to show a little bit of a high-level overview of these three financial statements. This is hopefully a reminder for everybody. I believe you will have taken an accounting class beforehand, if not having worked in the field. But at the very least, you'll have a little bit of some comfort with the accounting statements. And so this is just a quick recap of them. The balance sheet, the most important takeaway from the balance sheet is the fundamental accounting equation, which is right over here, assets equals liabilities plus owner's equity. And these things need to balance. Hence, it's called the balance sheet. And we can see some of the general categories here. This is a very high-level balance sheet. Many companies, most companies typically have much more detail. But everything falls somewhere into these categories, right? Assets, you have current, fixed assets, intangible assets. Those are short and long-term assets. Liabilities and owner's equities, there's current and long-term liabilities, and then there's the owner's equity. So, and again, the total assets here, these things add up. They balance out. The next financial statement we'll talk about is the income statement. And so this shows the profits over a given period of time, and it's matching up for the revenues that were generated within a given time period. It's trying to estimate the costs that were related to those revenues. So this is a typical high-level income statement. We've got our revenues, we subtract our cost of goods sold, and we get our gross profits. From there, we can subtract our operating expenses, and we get our net income before taxes. And then we subtract out the taxes, and finally we get our net income or net loss. And you can add a lot of details within this. You can zoom in on different categories and so on. But this is the general structure, and it's good just to have this in your head as we go through different parts of the course, because we'll be using these concepts. So finally, the last one that we'll talk about, the last financial statement, is the statement of cash flows. And this is, as I was saying before, a breakdown of all the cash activity categorized into 3 different buckets: operating, investment, and financing for a given period. So I gave an example of one here. Let's say we start with $1,000. This is in thousands, so $1 million of cash. And maybe we had $10 million come in from operations, $3 million go out into investing. We bought some fixed assets, and then we also paid out $4 million in financing activities for a net change of $3 million. And we add our $1 million to our $3 million, and the ending cash balance on the balance sheet should be $4 million. So this is just a very high-level overview of how this works. So now, the accounting statements, they're very good, and they're really a critical place to start for financial managers trying to understand, get a handle on their company. But it's got some limitations, and one of them is that the accounting statements are based on the accrual method. And when we think about value creation for investors or lenders, they're actually more interested in cash. The accrual, they can't spend accrual, but they can spend cash. And additionally, accounting measures can be managed. Company management can make accrual numbers look a little better for reporting purposes, at least for a little while. Eventually things catch up. But it's hard to massage the cash. It's not impossible, but it's harder to massage the cash than it is the accrual accounting. So for these reasons, and for some others, but these are the main ones, we, in our area of corporate finance or finance in general, we focus on what's called the free cash flows. And we can define the free cash flows as simply the cash that's available to be freely distributed to investors and lenders after a company satisfies all its operating cash needs. So after it pays for its any costs related to sales, any investment in working capital, or any investment in long-term assets. Once it's spent all that money, whatever's left over from operations, we define as the free cash flow, and those can be essentially returned to the investors and the lenders. We can operationalize this a little bit, define it as the free cash flows is equal to the operating cash flow minus the investment in operating capital. We can even take these one level deeper. The operating cash flow, that's in the first brackets, that's the earnings before interest and taxes, the EBIT, minus the taxes, minus the depreciation. If you group those first terms together, EBIT minus taxes, you actually have net operating profit after taxes, no PATs. You'll see that in the textbook. That's fairly common language. But the way to think through it, you can kind of get confused when you start to put the accounting labels in there. You want to just bring it back to operating cash flow. and then you can kind of think through it a little bit more. Equally, the investment, the second term, the investment in operating capital, we can break that out, that's in the second term in brackets, the increase in gross fixed assets plus the increase in net operating working capital. What is this really saying? It's saying that the first term relates to items from the income statement, and the second term relates to items from the balance sheet. So the operating cash flow is the cash related to the net income, and the investment in operating capital is the cash change that relates to balance sheet activity. Right? So if our spontaneous working capital changes, our accounts receivable or accounts payable changes, or if we invest in some new equipment, some longer term assets, that's going to affect our operating capital investment, and so then that impacts our free cash flow. So that's the basic idea of the free cash flow, and we're going to use that throughout in different parts of the course as our proxy for what's really going on, for the how is the company generating its cash position. So we use this typically in place of something like net income. It's a little bit more detailed and more accurate. What can we use the free cash flow for? Well, I said it can be used to pay back, freely pay back investors and lenders. So just to be a little more specific, we can pay interest on debt. We can pay back principal on the debt. We can pay dividends to shareholders. We can buy back stock, it's kind of like paying a dividend. And we can invest or buy some non-operating assets, marketable securities, invest in other companies. We can park the money into something else for a time being. And these are essentially the 5 things that we can do with our free cash flow. And we're most interested in really the first 4 we're going to talk about at different points in the course. So I mentioned that another tool that financial managers use is something called financial ratios. And we can analyze, once we've built those financial statements, we can actually analyze them with something called financial ratios, where we can grab 2 different metrics, either from the income statement or from the balance sheet or a combination, or even some other company level metrics. Its market value, and that's probably the most common one of the non-financial statement metrics. And we can create a number of different categories of ratios that managers use to help understand what's going on in the company. I call these dipstick measures. You kind of stick them in, and you see what the measure tells you, and then you measure another one, and you see what that's telling you, and you do a few different measures, and you have a pretty good understanding of some of what's happening in the company. And the major categories are liquidity ratios, asset management ratios, debt management ratios, and profitability ratios. So, for example, within the liquidity ratios, we're really answering the question, are the operations covering the immediate cash needs? Are we going to just run out of cash? That's a bad problem. So company managers want to make sure that doesn't happen. A couple of examples are the quick and the current ratios. Some asset management ratios. So this is trying to assess how efficiently is the firm using its assets. The more efficiently a company uses its assets, typically the higher the value it will create for its shareholders. So that's an important measurement. And some common measurements, some common ratios are the inventory turnover. How fast does inventory turn over? The days sales outstanding. How long do our sales sit on the books? And then our total asset turnover. And there are others, but these are some examples of some of the more common ones. Debt management ratios are some companies, many companies, although not all, will use debt or borrowings for part of its financing. And when that's the case, companies want to make sure that they have enough money that they can pay for their these financial obligations, because they're legally obligated to pay back their lenders. And so a debt ratio or a capital structure ratio is a pretty typical ratio for here. Times interest earned. How many times do we earn the interest that we owe? And the more times we earn that interest, the safer we are. The more likely we'll be able to pay the interest. And there's other debt management ratios. This is the more debt a company has on its books, the more it borrows to pay for things, the more important using these ratios are to make sure things don't go badly. There's no surprises. And finally, the other big category of ratios is the profitability ratios, and we're looking at really different slices of profitability or rates of return compared to sales or assets and equity. And some of the big examples of here are the return on assets, the ROA, or the return on equity, the ROE, and there are others, but these are some of the big ones. And by themselves, these ratios can and do have value, but what's often even more valuable is to compare, once we've done a bunch of ratios, we've done a ratio analysis and created a list of a handful of what we think are useful ratios for a company. It is often helpful to benchmark those ratios against a comparison group of companies. Typically, it's other companies in the same industry as the company that we're working with. And we'll want to create ratios for those companies and then see how our company's doing. Is it above the average, below the average? If it's below the average, why? Can we tell a story? Is it calling attention to a problem that needs to be fixed or addressed or something? So you can do a lot of different things with these, and these are good, what I would call first stops towards understanding for diagnostic tools that managers have on the road to value creation. And we'll use some of these throughout the course or at later points of the course. But more than anything, this really just gets our feet wet into understanding how can we think about how well a company is doing. And then in subsequent weeks, we will build more financial tools through a little bit more finance theory that we'll create that will do even more heavy lifting than these tools. So let me just put all of what we've been talking about into context visually. And we saw this map in our introductory lecture, and this is showing it's really trying to take all aspects of the value creation process and essentially the value creation equation and putting it into one slide. And at different points in the course, we work on different aspects of this. So in this case, we're really focused on this top half, right? The sales minus the operating costs and taxes minus required investments and operating capital. Those are all the financial statement items, and they lead to the free cash flow. And the free cash flow then is something that is in this equation in the middle that we will elaborate on much more greatly next week. But for those familiar with the time value of money, as a reminder, this is simply our time value of money equation. Again, if that's a little fuzzy for you, we will demystify that next week when we really focus on the heart of this value equation process. So that is our lecture for Module 1, and hopefully it really gets your appetite a little wet for what is going to follow when we fill more of the details in this visual diagram. All right, thanks.